Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for Wednesday, June 10th. My name is Ian Saunders, and joined here by Will Gibson. And coming in this week to continue to see some general upward swing to a lot of spaces across the domestic equity market. Although the past couple days have led to rather muted advances for the Nasdaq Composite Index, which is now recently moved as of yesterday to continue to mark new all-time highs. The S&P 500 and the Dow are showing rather muted losses, at least at the time of this recording on this Wednesday, but generally continue to see an upward swing from a lot of areas across domestic equity markets. And we've seen that reflected in the prices of the major indexes that we touched on there, and also continue to see that reflected in some of our broader indicators, such as the Dolly tool. Now, the Dolly tools, Dolly stands for Dynamic Asset Level Investing, is a way for us to compare at an initial glance the broad six asset classes against one another on a relative strength basis to see which ones come out on top the most, right? Which ones are going to be those long-term big picture areas of strength that we see in the market. And we saw domestic equities fall off pretty significantly in that ranking earlier this year, as we touched on in prior episodes of the podcast. Recently moved back up a little bit ago, back into the third position where it sits here currently. Hasn't quite risen enough to overtake the fixed income or cash, which sit at 2 and 1 respectively. But one thing that is definitely significant to note is that the domestic equities asset class has continued to pick up buy signals over the past several days and few weeks here, currently sitting at a buy signal tally count of 208, which is its highest signal count since the market volatility, market decline began there in mid-March. On the flip side, cash and fixed income, which still sit in the top positioning, have continued to lose buy signals. So what that means is that while the broad asset class rankings haven't necessarily changed as you may expect in coming in and looking at the tool, we have seen some movement underneath the hood of those broad rankings themselves. So it's definitely a good sign to continue to see the domestic equities asset class pick up signals relative to the rest of the field. And if we take a look further underneath the hood, one way we can do that is through the Dolly details page that we have on the platform, which sheds some light on some other indicators that we have on the page. As I mentioned, the buy signal count that leads to the asset class rank is going to be that big picture, long-term view of where we see strength in the broad six asset classes. Again, focus there on long term. It doesn't change very often, and it's very significant when it does change. It's not something that we want to be flip-flopping, right? In order to take a look at maybe a more intermediate term picture, one indicator that you could use on this page is the cash percentile rank. This is going to be found in the middle column there on the page for those of you who are following along via YouTube. But this reading essentially is taking a comparison of representatives from each asset class. In this case, we're going to be focusing on domestic equities, and then putting those into what we call relative strength matrix ranking, essentially stacking up the relative comparisons against one another to see which areas are higher. And then we throw money market, our cash proxy, into that ranking as well. And so the reading you're going to see there on the page, which is currently listed at 29.09, is essentially going to tell you out of our basket of domestic equity names that we're looking at, what percent is cash beating. Right now, it's only been 29.09%. And this is a reading that we've seen continue to fall over the past several weeks. Its indicator functions in thirds. So if it is in the cash is in the middle or the bottom third, like we see now, that's indicating a strong asset class against cash. If it's in the middle third, what we call the average zone from 33 to 66%, that's indicating an average asset class against cash. And up in the top third, if cash rose into the top third of those matrix ranks, 66% or higher, would indicate a weak asset class against cash. And so we saw that reading get as high as 95% during the market decline there in March, and has then continued to steadily move lower over the past several weeks to bring us down into the strong territory, into the green zone, as we'd see there on the page, which is further confirmation on other indicators that we've seen flip positive, such as the bogey check, which moved to a pass there several weeks ago. So having the domestic equities cash percentile rank now move back down into that bottom third at 29% is definitely a further kind of confirmation on the general upward swing that we've seen for the broader equity market. And we'll continue to look towards the asset class buy signal tally changes as we look for that asset class to continue to rise in the ranks. But given that broader movement we've seen for the asset class as a whole, we've seen a fair amount of rotation within the asset class in this market rally. Specifically over the past couple of weeks here, seen a lot of those laggard areas, those areas that have been really kind of underperforming other sectors and other size and style classifications throughout the market rally begin to pick up the pace a little bit. Technology has been the long-term bellwether for most of the period. And on the flip side, the large cap growth space has and continues to be the kind of the place to be within your size and style breakdown. We did over the past week, though, see small cap growth move back in the top 3 on our size and style breakdown. So just behind mid cap growth and large cap growth. But definitely a good sign to see some of those laggard areas continue to push higher, seeing that broader participation continue to come back into view for the broader domestic equity markets. Is that right? Well,
yeah, Ian, for sure. We're certainly seeing a lot more increased participation across the board. As you mentioned, some of those previously laggard or lagging areas have been picking up the steam, seeing the increased participation. One area, or more or less, that's made a lot of noise lately has been the energy space, right? From a sector perspective, in Dali now, we see it ranking as the number 1 sector, actually outpacing technology, a previous long-term holder of that number 1 rank in terms of sector, domestic equity sectors. So now we have energy at the top of Dali, followed by technology, still very strong as a group, still demonstrating a lot of long-term relative strength. Nonetheless, the near-term strength from energy has manifested in that change in rankings within Dali. In addition to that, we've seen consumer cyclicals pick up the pace as well, moving towards the top. And then we have healthcare following at the number 4th rank and communication services at the 5th rank. So definitely seeing some shakeups in the domestic equity sector's rankings in Dali. And a number of our models actually have picked up on that as well. As of most recently, the Focus 5 model, if you're familiar with that, it's owning 5 domestic equity sector ETFs. That model just recently allocated into energy as well as consumer discretionary. And if you're following on YouTube, I am on the models page and we're taking a look at the recent trades for the Focus 5. And again, as of lately, the model has picked up on some of these broader sector changes or these rotations that we've seen, being consumer discretionary added exposure as well as added exposure into energy. And that was at the expense of utilities and healthcare. So Ian, we're definitely seeing some increased participation, a bit of rotation, and some of our strategies are picking up on that. With that increased participation, though, it's just been so drastic and so aggressive, perhaps. So maybe taking a step back, what are we seeing from maybe a bit broader, stepped out perspective in terms of this near term, perhaps overwhelming amount of strength?
Yeah, absolutely. And I mean, in looking at the sectors there as well, I mean, we can still see the Focus 5 model, again, in those 5 strongest relative strength areas, as well mentioned there. It still has the overweight towards technology at just over 50% of the fund. But we're seeing, I mean, this broad participation that Will mentioned is definitely coming into play. Consumer cyclicals making up over 22%, energy making up about 17%. There from you can see there on the models page. Definitely showing some areas of improvement outside of just the bellwether technology sector that has been really the place to beat for much of the last 3 years. So this participation, as Will mentioned, has led the broader domestic equity space, again, to continue to pick up strength, but is now creeping back towards more overbought territory. One way we can view this is by looking at the default chart of the S&P 500, and then actually pivoting from there over to the 20-point chart, So if we look at the 20-point chart of the S&P 500, we can see, again, further confirmation, movement to the upside after we broke back through to a positive trend there, 2940, right at the end of April. And then towards the end of the month of May, and then definitely here over the first week of June, I've seen a significant rally for this broad index, moving up to a current chart level of 3220 on this 20-point chart. So even though we've gotten a little bit of muted performance here over the past couple days, you'll see the default chart for the S&P did reverse down into a column of those. picture that we've been looking at here, this 20-point chart that provides some more of a kind of an intermediate term view, hasn't reversed down into a column of O's. That would not come until we get down to the 3160 point, if that was to occur. And so this continued swing we've seen upside, this continued enhanced rally that we've seen over the past couple of weeks here, has led the index to a weekly overbought oversold reading of 90%. And so that's looking at the weekly OBOS reading that's going to be in the upper right-hand corner of the chart page, which is looking at essentially we're going to take the 10-week trailing trading band that you can see on the chart, but the 10-week trailing trading band, and basically saying, okay, where does the current chart level that we see here now, where does that relate to movement we've seen over the past 10 weeks? So your midpoint on that chart is going to correspond to the 10-week moving average, which is going to be pretty close to the 50-day moving average you see directly above the chart page. And seeing the index, the 50-day moving average there at 2872, and the index now up at the 3220 level on the chart, is indicating that things are definitely getting more overextended. If we look at the history of that particular overbought oversold reading, the index is certainly not new to overbought readings. However, it's definitely a new thing to see over the past several weeks. The last time we were up at these elevated territory was going to be prior to this market decline. We saw the S&P 500 get to a weekly overbought oversold reading above 70% on Valentine's Day on February 14th. And then with the market decline that ensued over the next several weeks, it moved into heavily washed out positioning, ultimately falling to a low level of negative 185%. So extremely washed out territory, extremely oversold territory on this chart. And then we've seen with that sharp V shape that has been mentioned across many news outlets or across our research here, has led the market to rebound rather quickly back into overbought territory. So it's nothing to necessarily be overly concerned with. It's not necessarily saying just because we're reaching these levels that you need to go ahead and pull the plug on things that you're looking at here, but definitely something to keep note of, and certainly something to keep note of for individual positions that you might be looking to examine there. This overbought oversold reading is something we're going to have for every individual stock within the S&P, as well as the index itself, as well as the rest of the symbols and tickers that we have here on the platform. So we typically use that 70% threshold as kind of a line of demarcation. And so now seeing the S&P 500 creep back above that threshold, definitely something to keep note of and keep track of in the individual positions that you're managing there yourself.
Yeah, Ian, that's right. And in the near term, we have touched a bit on the overbought short-term picture for the market, whether it be looking at that overbought oversold reading, as we touched on later this week in some of our research. Another thing that actually came across that we were talking about before this is the implied momentum bell curve. And that's found on the Nasdaq Dorsey Wright platform. But in essence, this is going to be telling us a near-term picture of an overbought or oversold status of the market. And we're using individual stocks to do so. So typically a stock's volatility is going to be calculated using historical prices, and we're going to use standard deviation manifesting in that 10-week trading band like Ian was just talking about in regards to the S&P. So it gives you an idea of the volatility of the stock and or index and where the current price is currently represented within that distribution. So again, if you're high or towards the top of the distribution, it's going to be near-term overbought, bottom, you're going to be near-term oversold. And this is all based on statistics, right? Now, the implied momentum bell curve is actually going to be using the Black-Scholes option pricing equation, and is giving us an opportunity to back solve for the forward-looking volatility using the price of the option for each stock. So again, point being, zone 6 or a skewed distribution towards the right is going to indicate a currently heavily overbought territory for the market, where a skewed left distribution is going to indicate perhaps a heavily oversold territory for the market. And we note here, and I'll have to scroll down if you're following on YouTube, but if you happen to find this on the platform later today or tomorrow or whenever, you'll note a heavy stacking in the zone 6 category, or more or less a heavy rightward skew. And you'll actually notice that there are no stocks in zone 1 or zone 2. So nonetheless, this is supporting the case for a near-term overbought posture in the market. And just for perspective, I put in March 23rd on the platform, a previous bottom for the broad domestic equity markets, and we get a vastly different picture. We get a heavy skew towards the left, and we actually don't have any stocks in zone 6. We have one stock in zone 5 and a handful in zone 4 back at this current market environment on March 23rd. So again, we are cherry picking dates here for the implied momentum bell curve, but nonetheless, we do see an argument to be made in terms of statistics suggesting perhaps a near-term overbought posture for the market, in addition to the rotations that we've seen thus far.
Certainly there will. And I think another point that it might be useful as well, if I'm scrolling back up to the top there, up at the top of this implied momentum bell curve, as you mentioned there's 6 zones, right? We're currently heavily overweighted towards the zone 6, indicating a more overextended or overbought stance. You can see that also through the average level. So I'm looking at the average level of the names in the S&P 500 that we have here on this bell curve. It's currently at 5.53, indicating that on the zone basis, zones 1 through 6, the average level between those zones is 5.53. As you mentioned there, when we were looking at the prior date on March 23rd, we were looking at an average level of 1.17. So very quick move here into the overextended territory, indicating that a lot of these names may be creeping back up towards or be in overbought positioning. And that doesn't necessarily mean they're going to be out of favor. It just means if something's in an overbought position or in overextended positioning according to their individual trading bands, could be an area to wait for a pullback before moving in on. So definitely still seeing that kind of broad continued strength coming back into place for domestic equities as the market continues to rally. But certainly an area to keep an eye on there, and some of these individual overbought, oversold positionings, making sure you're getting in these names at the right time. So with that, I think we've wrapped up most of what we were looking to cover here on this Wednesday afternoon. If you have any questions on any individual names you're monitoring, maybe some of their own individual overbought or oversold readings, or any of the model changes that we've touched on here today, definitely never hesitate to reach out to us here at Nasdaq Dorsey Wright. You're more than welcome to reach out to us via phone at 804-320-8511. Or also, if you'd rather type than talk, you can also reach out to us there via email at dwa@dorseyright.com. So with that, Will, thank you very much for joining me here this afternoon. No shortage of things that we could continue to talk about here, but I think we've touched on most of what we were looking to cover here. Thank everyone very much for joining us here on this Wednesday, and we look forward to having you back next week.